Good afternoon, everyone, and welcome to the superannuation update for the June quarter. My name is Brett Griffiths, and I'm going to be talking you through essentially some of the updates that have happened over the past little while, as well as some dates that are important coming into 30 June, or some ideas to come into 30 June, as well as some dates that are critical after 30 June as well. So we shall get started. Basically, first of all, you have to know what while you might believe me, you can't actually take this as being advice for your situation, unless of course you talk to us. So that's that. Basically, my details. So if you have more questions around the content, or you want to talk to me just generally about superannuation, by all means. So what are we going to be talking about today? Well, essentially, some upcoming dates that are rather key to superannuation and tax generally. We're going to talk about some updates around things that have happened over the last few months that are relevant in a sort of summary form, and then in more detail at the back end, but I'll touch on a tick. So updates from the ATO website. We'll touch on the contribution caps that are coming up for 23-24 financial year. Some other key dates and rates for the 24 financial year. Some contribution tips. So basically how you can get more money into super leading up to 30 June, if that's applicable for you. And then we'll also talk about NALI, which is the non-arm's length expenses. So there's been some movement in the station, so to speak, around that in the last budget, as well as a new tax that's coming into super for large balances. So we'll touch on that as well. So let's have a look at some important dates that are coming up. So pre-30 June, obviously that's a big one. So need to make sure that the basics are done. The housekeeping of the super fund is done, or the self-managed fund is done. So minimum pension payments have been made prior to 30 June. Now, remember that that needs to be done in cash and needs to happen before 30 June. In other words, it appears on the bank statement as coming out prior to 30 June. Contributions made and received prior to 30 June. Bearing in mind that some of the clearinghouses and payment gateways can take some time to process superannuation payments. In fact, I think the ATO gateway is actually out of action for a few days before 30 June. So I would strongly recommend, if you're using a clearinghouse or a payment gateway, do the contribution next week, because it actually has to be received by the super fund for it to be a contribution for this financial year. So received prior to 30 June to be a contribution. So basically, it leaving your bank account or the employer's bank account is not sufficient. It actually has to be received by the fund. Some clearinghouses can take a week to do that process. So better to be safe than sorry. If the fund has owns a property that is leased to a related business, then make sure that that rent has been paid up to date. Ideally, it should be paid on a monthly basis, but at least make sure that at the end of the financial year that all the payments are up to date. Same with interest. So if there's a loan to a related party, either way, so in other words, it's an asset loan or a liability loan, so they've bought a property potentially, make sure that all those loan repayments have been made and the interest has been calculated correctly. And obviously asset valuations. So 30 June is the key date for asset valuations. Well, they don't have to be as at 30 June. Often it's easier to get them around this time because it's more reflective of what the value is for the financial statement preparation. So just some basic sort of housekeeping to bear in mind as we run into 30 June. As far as post 30 June, some dates to be mindful of. So the transfer balance account reports are actually due for events that have occurred during the June quarter, so between 1 April to 30 June. those reports are due to be lodged by the 28th of July. Now, what they would contain are things like pension commencements, computation of lump sums, that sort of thing. So it's important to actually understand the transactions that have happened inside your fund, or if you're an accountant preparing the funds, your client's funds, so that way you're able to actually meet that lodgement deadline. Bearing in mind that APRA funds have 10 days to do those lodgements, self-managed funds have 28 days. Also, 28 July is when the super guarantee payments are due for the April to June quarter. Reminding you that in the last budget, that will move to the payroll cycle in a couple of years. So, but for now, we're still on the quarterly cycle. 28th of August, the due date for the for paying your super guarantee charge. So in other words, if you didn't make the 28th July, you can essentially self-assess that you didn't quite make it by the 28th of August. And there's forms and so forth you fill out on that. And also on the 28th of August is when the June activity statements are to be lodged, so BAS and the IASs. And that's if you're going through a tax agent. If you're doing those personally, then it's actually 28 July as well. And they're really the only key dates before 30 September. As we hit the next quarter, then there's some more due dates, obviously. But for this quarter, or the coming quarter, I should say, they're the only due dates that are applicable to super. So now let's touch about some updates that are that have happened over the past little while. So the first one relates to minimum pensions. So for the past couple of years, there's been a COVID relief in place that had a 50% reduction on pension payments. Now, that goes away come 1 July this year. So we're back to the standard withdrawal rate, which, as you can see there, ranges between 4% and 11%, depending on the age of the member. So next financial year, there'll be a lot more liquidity requirements for self-managed super funds, well, all funds, but self-managed super funds that are paying pensions. So just bear that in mind. TBAR reporting, now I touched on before around the timing of that reporting and when it needs to be lodged. There's also a change in the frequency and how they have to be reported. So previously, if a member had less than $1 million inside that self-managed fund, the fund only actually needed to report on an annual basis TBAR events. From 1 July 23, the self-managed super fund is actually required to report transfer balance cap events no later than 28 days after the end of the quarter. So that's regardless of member balances, that's for every self-managed fund. So basically, all unreported events that occurred before 30 September 2023 have to be reported by the 23rd of October. Now, as a practitioner, you've sort of got to ask, how are you going to do that? You know, if you're busy doing your normal compliance and then a client wants to start a pension or wants to stop a pension, perhaps they die, they're all the reportable events that you need to be on top of. So you need to sort of think about how you can actually achieve this as a practitioner. The easiest way is to do continuous reporting. So that's what we do here at Vincent's. Our team essentially looks at the transactions on a regular basis just to make sure that everything's up to date and is ready to be pulled together in a relatively short period of time. It won't be perfect, but within a few days, we'll be able to pull that information together. Superstream relief is ending from 1 July. So essentially, from March 22, the trustees have been able to go to the tax office and ask them for approval to be outside of the Superstream system. That will now end. So basically, from 1 July, a self-managed super fund that wants to make a rollover, receive a rollover, and also for release authorities has to have an ESA, so an electronic service address, so they can actually undertake that work. And otherwise, the auditor is obligated to contravene the super fund for not meeting their obligations, their requirements. There's also important to note that there's a 3-day requirement to effect a rollover or a release authority. So once again, you've got to be able to receive that notification via your gateway software, however you receive your ESA notifications, and then communicate that to the client, so then they can take action, or just to acknowledge that the rollover has been received and the cash has been received. So once again, it means either talking to clients, having data feeds, so you can have that information available to you. And the final one here around the updates is just in relation to the Commonwealth Seniors Healthcare Card. The income thresholds were increased 1 January this year. So $90,000 for singles, $144,000 for couples, or $180,000 for couples that are separated because of illness or the like. So just something to bear in mind, because there are people that are eligible for the Commonwealth Seniors Healthcare Card that might not actually appreciate they are. Now, the ATO website updates, they've actually been a little bit busy of late. So we've got a few of those just to quickly run through. So firstly, death versus member benefit. So this situation arises essentially when a member requests to take money out of a fund, typically a self-managed super fund, and then they die before that payment has actually been made. So the ATO have put together some guidance for trustees as to how to treat those payments, if they're a death benefit or a member benefit. Now, the reason why this is important is if it's a death benefit, typically there is no tax on that. However, on that payment. However, if it's a member benefit that is going to a non-dependent, there can be taxed up to 15% or 17% if it's directly to the member from the fund. Sorry, from the benefit to the beneficiary from the fund. So if you're talking about a decent sum of money, that's obviously a bit of tax that is essentially at play. So it's very worthwhile to ensure that you, excuse me, to ensure that you actually know what type of benefit you're paying. So the ATO have put together this guidance. If you Google that QC code there, you'll find it. Basically, the rule, if you like, that the ATO have landed on, if the trustees that they must address whether it is a member benefit or death benefit based on the facts known at the time. So in other words, if the member has made the request, bearing in mind that members and trustees are usually the same, the member has made the request, instructions have to be undertaken to make that payment before death. So if it's done after death, then the chances are that even though the member has requested it, it's probably going to be a death benefit. And the reality is a private binding ruling is probably the safest option in this regard, because that way you actually get to lay out all the facts on the table, including evidence of email chains or instructions via telephone. Lay all that on the table and the tax office make the decision for you. If you go to the private binding ruling section on the ATO website, you'll see a lot of these questions that have been asked, obviously desensitized. So that way that'll also give you a bit of a flavour. But with those existing private binding rulings, but more so with this guidance that the ATO have put out, it'll help you make that decision if it's relevant, of course. ABN cancellations, essentially the ATO are now giving us another 2 weeks before they cancel the ABN for self-managed super funds. So it was 14 days. They've taken that up to 28 days. So that will just allow for tax refunds, rollovers using ESA, things like that before the ABN is actually cancelled, because there's a few situations where the ABN was cancelled and rollovers couldn't occur for argument's sake. So that's what that's for. The ATO have also updated or released a practice statement in relation to rectification directions. So PS LA 2023-1, self-managed super funds rectification directions for contraventions of the SIS Act. So this practice statement, basically, it's an internal document that the ATO make public. So that way we can see the process that ATO staff go through in relation to making these sort of determinations or directions. So basically it gives guidance to the ATO staff as to what needs to be considered before they actually give a rectification direction. So it's just a helpful tool to help understand their side of the fence, being the tax officers. So that way, either you as a practitioner or you as a client, as a trustee, understand what the ATO will be looking for and will do in relation to making those sort of directions. And finally, the ATO has also released a draft legislative instrument, LI 2023 D11, which is basically to ensure that those people that were relying on the extended definition of an employee under SIS are still able to claim a tax deduction for their personal contributions. So previously, the work test was actually buried. We had a work test inside the SIS Act, so it was always consistent between being able to make a contribution and claim a tax deduction for it. But what they've done is they've basically moved the deductibility or the work test side of things into the tax legislation. So now there was a little bit of a void in relation to a definition of employee, because it's sitting on the Tax Act. So they've introduced this draft instrument that basically says that what's in the SIS Act now applies to the Tax Act for that definition. So for things like company directors, parliamentarians, funnily enough, local government councillors and police officers, so they can all now be considered employees under the Tax Act and claim personal tax deductions. So no real change as such, but more of a technical change, I suppose. Moving on to the contribution caps. So basically, these are the rules moving forward for the 23-24 financial year, so from 1 July onwards. So concessional contribution caps. So the general cap remains at 27,500, regardless of age. So that hasn't changed. So that's still the same as what it was in the current financial year, or what it is in the current financial year. Members aged between 67 to 74 need to meet a work test in order to claim a tax deduction for personal contributions, which is gainful employment for at least 40 hours and 30 consecutive days during the financial year. Doesn't have to be before the contribution, just has to happen during the year. Now, this is only if people are claiming a personal contribution. If it's an employer contribution, then they are automatically deemed to satisfy this work test, essentially. So there's no extra hurdle to jump through. Employer contributions are always deductible. And there's also a little interesting one too, where there's a work test exemption for recent retirees that allows members between 67 and 74 with a total super balance of less than 300,000 to claim a tax deduction for personal contributions made within the 12 months after they finished work. So the theory behind this is that they've stopped work, They might have received a bona fide redundancy, or they might have received a payout of some way, shape, or form. They're able to put money into super if their balance is less than 300,000, even if they don't meet that work test. So just something to bear in mind. It's obviously designed to help build people with lower balances, to help build those up. Non-concessional contributions is the natural flow from there. So basically, for non-concessionals, you can put in up to 75, up to the relevant thresholds without a work test. If you're from age 74 and younger, you can put in non-concessional contributions without a work test. So there's a lower threshold, so to speak, in relation to non-concessional contributions. However, you can't make non-concessional contributions if you are over your total super balance of $1.9 million. And then which is what it will be from 1 July going forward. So basically, there's a bit of a scale thing that goes on. So starting at the top of the little table there, if your total super balance as at 30 June 2023 is less than 1.68 million, you can put in the full 3-year bring forward non-concessional contribution of $330,000. If your balance is between 1.68 and 1.67, you can only put 2 years worth in, or $220,000. And likewise, if it's between 1.79 and 1.9, you can put in 1 year's worth. So it doesn't matter if you had $1 less than $1.9 million inside your total super balance. So long as you're just under, it means you can do the whole $110,000. Now, excuse me, noting that it relies on your 30 June balance. So the same applies to this year, except the numbers are different because the total super balance cap is only $1.7 million this financial year. It increases to 1.9 from 1 July. But you need to have your 30 June 2023 balance determined before you can do these contributions with some safety. Otherwise, it could be deemed an excess contribution, which then means that it goes through the ATO process of having to pull it out of super. So as an excess contribution. So always best to wait just to be safe. So some other rates that are applicable. As I've been talking about, the transfer balance cap has increased for 1.9 million, and that's because of CPI increase. So that one increases with CPI, so that's why. Super guarantee has increased to 11% for next financial year, currently 10.5%. So bear that in mind for if you're making superannuation payments from 1 July, obviously. The super guarantee, the maximum super contribution base for the 24 financial year is now $62,270 per quarter. So that's how much you can earn without you. If you earn more than that money, probably the easiest way to put it, more than $62,270, then you can actually say to your employer, don't pay me any more super. Now, if you're going to do that, you might want to think about having them redirect that into your personal name, because ultimately that's where it's going to happen. If they still put it into super, treat it as excess contribution, the ATO then assesses that and makes you pull it out. So it's the same net result, but it may be easier for the employer just to keep on paying super. But if you have the opportunity, it's best for you, less hassle, if they just pay it into your bank account, if you're starting to earn more than 62,270 per quarter. The small business CGT lifetime cap is increased to $1.705 million. However, the Division 293 tax threshold is still at $250,000. So no change on that one. Superannuation lump sum benefit caps So the low rate cap is now increased to $235,000, and the untaxed plan cap is now 1.705 million. And finally, eligible for downsizer. So that actually changed to 55 from 1 January this year. It used to be 60, so now it's down to 55. However, the limit is still at $300,000 per person. So if you've got a husband and wife, then they can put in $600,000 combined. So, but that is now from age 55. Remembering you can only use it once, it's a lifetime cap. So once you've used it, that's it. No more you can't reuse it again down the track. If you only use part of it, then you can use the remainder in the future, so long as you satisfy the other criteria. And the final update on the rates that I just want to talk about is the limited recourse borrowing arrangements, so the related party loans. The ATO's safe harbour interest rate, based on the RBA's particular criteria, it's the housing standard rate variable, is actually 8.85%. So that's determined off the May figures, so that way you know what it is moving forward. So 8.85% for real property and an extra 2% for listed shares, so 10.85%. So this is where you are acting, or the client is acting as the bank by lending money to the super fund to acquire a single acquirable asset under the limited recourse borrowing arrangements. So not overly common, but they certainly do exist. And that interest has gone up about 3%, 2.5% from last year. So it's a significant increase. So, excuse me, need to make sure that you or your clients are actually paying the correct interest from 1 July going forward. I just thought it might be worthwhile just sharing a couple of little things to consider in relation to making contributions rolling into 30 June. So catch-up contributions, if your total super balance was less than $500,000 at the previous 30 June, then you can actually access any unused concessional contribution caps that you haven't used in the prior 5 years. So in other words, if you've put $10,000 in 1 year, then say it was back in 2019, you actually have another $15,000 that you can put into super now to use up that previous cap if you haven't already done so. So really good tool for if you have perhaps more income in this current financial year because of they might have sold an asset or just had a really good year personally. Good mechanism to actually do catch-up contributions, so long as your balance is less than that $500,000. Contribution splitting, this one's been around for a long time, but it's probably not utilised enough. So that's where 85% of the members' contribution, concessional contributions, can essentially be reallocated from the member making or receiving the contribution to their spouse. So it's just an internal thing that happens inside the fund. Excuse me. Inside the fund, typically self-managed funds do it because it's a bit harder for APRA funds because you've both got to be members of the same fund and so forth. It can happen, but it's more relevant for self-managed funds. And the spouse also needs to be under 65, so just bear that in mind. And contribution reserving or concessional contribution reserving. So this is where a contribution is made in the month of June, and it has to be made in the month of June. The trustee goes, oh, I don't know which member this is for, so I won't allocate it. The trustee has 28 days after the end of the month in which the contribution was made to make that allocation. So in other words, if the contribution is made in June, they have until the 20th of July to allocate it to a member. What this actually allows you to do is put 2 lots of contributions in this financial year. So let's say you did both of them right now, $55,000 in for me into super. I can treat one of those as a this year contribution and one as a next year contribution. However, I'm getting the tax deduction in this year for both, for that whole $55,000. In the super world, it's split between the two. And to let the ATO know this, you actually have to fill out a particular form, and send that to the tax office. So just bear that in mind, that if the form doesn't happen, then the ATO won't know about it. But it's a really good way to get a little bit more money into super if you need to. Okay, so that's sort of like the most of the update things. Now there's just 2 topics that I just want to touch on a little bit more detail. One is the non-arm's length expenses, and then also the new $3 million tax that's coming in. So let's go back to the start. What is a NALI? So non-arm's length income is a concept that has been around, well, it's been around as long as I can remember, and I've been doing this since '99. The idea of bringing expenses into the equation came about in 2018. So essentially, non-arm's length income is where income is derived that is not at an arm's length rate, not because of an arm's length arrangement. Non-arm's length expenses, or NRLE, is the same thing. There's an arrangement where an expense has been incurred, but it's not an arm's length arrangement. So it's not a commercial on commercial terms. So it was introduced, as I said, in 1 July 2018. That was all fine. So basically, if the fund's expenses were lower than they would have otherwise been in that situation, all or part of the fund's income could be regarded as NALI and taxed at 45%. So it's a rather big disincentive to do it. Now, back in 2018, it was all about the expenses of the fund. So in other words, I'll give you an example. If I bought some shares, for argument's sake, and I didn't pay the proper amount, then in theory, I could be taxed at NALI because I haven't paid enough for the shares. Putting aside other issues around arm's length and all the rest of it, a NALI provision could apply because you've underpaid expenses. Now, then the tax office released a law companion ruling back in 2021 that really got accountants essentially upset. And that was because they introduced this notion that general non-arm's length expenses could actually taint the entire income of the fund. So in other words, if I don't pay to have my superannuation fund prepared because Vincent's does it for me, I don't have to worry about it, then in theory that could be considered a NALI expense, which then means that every cent of income that my fund earns is tainted, and you pay top marginal tax on that, which realistically was deemed, well, a lot of accountants anyway, particularly, deemed it unfair, because why should it affect the whole fund if it is an expense? And the dichotomy around this is that as trustees, you're meant to act in the fiduciary duties of the members, but yet if you do too good a job in doing that, then you can actually fall foul of the Tax and Sis Act. So unfortunately, that's just the fine line that you can sometimes walk. Then earlier this year, we had a Treasury consultation paper that tried to put some new guidelines around it, how it would work. That was excluding APRA funds, which was interesting because essentially they've been deemed too large to fail or too large to have this test applied to them. And for self-managed funds, the maximum amount of taxable income would be 5 times the level of the general expenditure breach. So that basically means that it'll be 5 times whatever the difference would be between what the benefit or what you have paid to what you should have paid if it was an arm's length arrangement. So if I paid something for $1,000, should have been $2,000. That $1,000 difference is multiply that by 5 times, and then you multiply that by the tax rate of 45%. So that's what the Treasury consultation paper proposed. Where they've ultimately landed came out in the budget, which is basically still excludes APRA funds. However, for self-managed funds, it's now 2 times the level of general expenditure breach. So the example down the bottom there, you've got a $2,000 expense shortfall. So something should have cost, call it $5,000, you've only paid $3,000. That $2,000 difference has resulted in $1,800 worth of additional tax to pay. So you sort of saved with one hand, but then you've incurred the tax on the other. So you haven't really saved the same. So just walking through how the numbers work. So that $2,000 times it by 2, 4,000. 4,000 multiplied by 45% brings you 1,800 tax. So that's how it works. And it does also exclude contributions. So that's important because technically contributions are income for a super fund. So I suppose, what does that really mean? So from 1 July 2023, any services, such as accounting firms, if the service is provided to the SMSF by anyone other than the director of the corporate trustee, the SMSF needs to be charged an arm's length amount for that service. If the service is provided to the SMSF by the trustee and director, the question then becomes, in what capacity did they undertake those activities? Was it in the capacity as a trustee? In other words, they can't charge for it under the SIS Act. Or if it wasn't as a trustee capacity, then they do need to charge an arm's length amount. So for argument's sake, if it was an activity that was pulling together paperwork for the self-managed fund to give to the accountant, you can't charge your time to do that activity because that's a trustee role. However, if it was, I'm not sure, negotiating a contract, that might be outside the normal activities of a trustee. So it really will depend on the situation. But ultimately, what is an arm's length amount is the burning question. Essentially, it's got to be a sound commercial basis, so the pub test. Discount rates can be applied so long as it's consistent and there's a documented policy in place and it's normal commercial practices. So a discount policy for it's the same discounts provided to all employees, partners, shareholders, or office holders, or a particular group of people, then you can satisfy that criteria. If, however, that discount is influenced by an individual, so in other words, I might say, well, I'll give myself a discount, but I won't give someone else one, who's the same job title essentially as myself, then that isn't consistent with normal commercial practices, which then means that that would fall under the NALI expenses, or the NALI. So times by 2, times by 45%. So hopefully that helps give you a little bit of guidance in relation to how those NALI provisions work. But it's not just accountants. I use accountants because I am one. But think of someone who is a real estate agent and they don't put it through their normal rental pool book if they manage it themselves. Think of someone who was a stockbroker and they do free trades, or someone who is a builder and they do free work for fixing things up in the self-managed fund. So there's broader implications here. So it's really important that as trustees, you understand that if you do anything on behalf of the fund, if you would normally get paid for it, then the super fund should pay you for it. And likewise, as practitioners, if we see improvements going on properties or whatever it might be, then we need to be asking questions around why is there no expense on that? And that's only if they're a builder. If they're not a builder, if they're doing let's say they're doing some renovations on a property, if they're not a builder and they're doing them, that's okay. It's only if it's part of their trade and skill. And finally, I just want to touch on from the last budget, the new tax on larger balances, super balances. So essentially the way this will work at the moment, bearing in mind we've only had consultation papers, which was over the 2 weeks of Easter. As I've got there, hopefully we will see legislation come into Parliament around August, September this year. But the intention is that this will apply to members who have balances that exceed $3 million. So if your total super balance is greater than $3 million as at 1 July 2025, you're in the system. So what that means is that your earnings or your change in balance from 1 July 25 to 30 June 2026 is calculated. Now that earnings is adjusted for contributions and withdrawals, but it also includes unrealised gains at this stage because it is the change in your total superannuation balance from one to another. So think about ways in which that might play out, valuations, the tax or the accounting treatments inside the fund, things like that. It's going to work the same as the excess contribution system. So in other words, you will receive, if you're gone from 3 million to 3.5 million, the member will receive a notice saying you're over your $3 million cap, your earnings is $500,000, and that will go to the individual. In that, they'll say, this is how much tax you need to pay for that privilege, for that right. And then from there, the member can elect for the super fund to pay it. So then they'll have to fill out a form or do MyGov is better to say, yes, I want to elect to have that tax paid from my super fund. So that's $75,000 in the example I'm using. Have that paid by the 7,500 paid by the super fund. And then the super fund releases the money to the tax office. The tax office will then basically claim that. So the system is already designed, it's already in place, it's proven, so they're not having to reinvent anything. Really, the sticking point is now becoming around this calculation of earnings, because at this stage, it is going to factor in unrealised gains, which I think is a bit unfair, because it is highly unprecedented that we actually pay tax on something that hasn't been realised, particularly when if it goes up 1 year, you pay tax. If it goes down the next year, you just get a credit for any future gains, which may not actually apply. So anyway, watch this space. There's nothing really you need to worry about just at the moment. Once we see legislation, we'll obviously do a webinar on it, and we can talk about what that looks like, what it means, and essentially how you can work the system to make sure that you get the best result for you. And basically, that's the end of the June quarter update for superannuation. It doesn't look like we've had any questions, but by all means, if you have any questions, feel free to send them through to me and my contact details at the beginning of this webinar, and more than happy to help you out or to answer them. And on that note, I wish you a happy afternoon, in 16 days to 30 June. Thanks very much. Have a great day. Bye-bye.